This is Nightly Business Report with Tyler Matheson and Susie Guerra. Brought to you in part by
TheStreet.com, featuring Stephanie Link, who shares her investment strategies, stock picks, and market insights with Action Alerts Plus, the multi-million-dollar portfolio she manages with Jim Cramer. You can learn more at TheStreet.com/NBR.
Citi sinks. The Federal Reserve rejects the bank's capital plans and shares slide after the closing bell.
Short-term gain, long-term pain. Blackrock CEO Larry Fink tells every CEO in the S&P 500 to think twice before buying back stock and issuing dividends. Why? And is he right?
Odd couple, Facebook shares tumble after its surprise acquisition of virtual reality headset maker Oculus. And now many investors are asking, is it the right fit? We have all that and more tonight on Nightly Business Report for this Wednesday, March 26th.
Good evening, everyone, and welcome. It is a big evening for banking news. The Federal Reserve coming down hard on a number of financial institutions, barring them from increasing their dividends or buying back their own stocks until they have enough cash on hand to withstand another big financial shock. Citigroup is the biggest bank that got its capital return plans rejected by the Fed, sending shares lower initially in late trading today. The decision is a blow to the bank and marks the second time in 3 years that Citigroup has failed to win the Fed's approval for its plan to return money to shareholders. Kayla Tausche, who follows the banks for us, joins us now. Kayla, I would think that an awful lot of Citigroup shareholders, not to mention shareholders in other banks, are disappointed tonight that the capital return plans that they might have been expecting on 5 years after the crisis are now up in the air.
They're saying, fool me once, shame on you, fool me twice, shame on me. A lot of these investors believed former CEO Vikram Pandit in 2012 when the Fed rejected that plan and he said, this won't happen again, we don't understand what happened, and they had to keep the dividend at 1 cent per share. The dividend is still there, and it's 2014. Investors are saying we should be far past this by now.
Now, you know, the Citi's CEO, Mike Corbett, right?
Yes.
Gets a lot of high marks for all the good things he's done post-Pandit. But why it looks like Citi keeps getting targeted by the feds. Is Citi doing the right things?
It's unclear. The reason why the Fed objected to the plan at this stage was because they said on a qualitative basis, Citi just wouldn't be ready for another crisis. The Fed didn't like the way that Citi had prepared its own models for another crisis. So it has a big exposure in emerging markets. What if Asia, say, drops 20%? What if Mexico drops 50%? Modeling for certain scenarios like that just wasn't up to snuff for the Fed at Citigroup. Even though Corbett has gotten high marks, that was priority number one when he took the helm. And you have to think investors are going to be questioning where his priorities stand right now.
Other banks affected too, many of them the U.S. subsidiaries of foreign banks. But back to Citi now. They had wanted to increase their dividend to what, a nickel a share per quarter and raise the buyback. Is that now up in the air? That's not going to happen? That
will not happen. They have 90 days to resubmit to the Fed. But for now, it's status quo, $1.2 billion in share buybacks. They wanted $6.4 billion. High expectations. They overpromised. No doubt they're under-delivering.
All right, Kayla Tausche, thank you very much for being with us tonight.
And now to Bank of America, which will pay $9.5 billion to settle all litigation with the top federal regulator over mortgage securities that were sold to Fannie Mae and Freddie Mac between 2005 and 2007. But the settlements don't end there. Ken Lewis, the one-time chief executive at Bank of America, will pay $10 million to settle claims by New York State's Attorney General that he misled shareholders and the government in order to complete his bank's acquisition of struggling investment firm Merrill Lynch back in 2009.
Well, there's a lot to like on Facebook, just maybe not today. As we reported yesterday, the social networking giant announced its first ever acquisition of a hardware company, paying $2 billion for the privately held Oculus VR, which makes virtual reality goggles. The trouble is, Oculus has no real revenue just yet, and its technology is largely untested. And it comes a month after Facebook paid an astonishing $19 billion for the mobile messaging app WhatsApp. Investors will ask questions later. Today, they sent shares of Facebook tumbling 7%. That's their worst day in 4 months. Josh Lipton has more on Facebook's takeover of Oculus and the company's plans to move into a virtual world.
That social networks are going to be...
The computing platform of today is mobile. The computing platform of tomorrow could be virtual reality. That's the big bet Facebook's Mark Zuckerberg just made with his $2 billion acquisition of Oculus, which develops virtual reality technology. Users put on a headset and feel like they're inside and part of a video game. It's a totally immersive gaming experience, which Facebook sees as the next big opportunity.
It seems like they've done a pretty good job of securing market share and opportunities when it comes to mobile, and they're thinking about what's next. And to them, seemingly, virtual reality is one of those areas where you could see some new paradigm.
Zuckerberg says virtual reality has all kinds of applications. Imagine feeling like you're courtside at a game, talking one-on-one with your doctor, or studying in a classroom halfway around the world.
Is that clear?
This isn't just sci-fi fantasy. Sony last week let me try out its virtual reality headset. I was virtually transported underwater in a cage, surrounded by sharks. It was so real that after a few minutes, I was ready to throw off the headset. So what's the business model Zuckerberg imagines? He says Facebook isn't looking to make money off the hardware. Instead, he sees virtual reality as a new social network, a new way of communicating where users can come together and also buy goods and services. Analysts say the acquisition is also about perception, making sure Facebook is thought of as a dynamic company pursuing cutting-edge technology.
There's clearly a kind of land grab that seems to be going on in Silicon Valley when it comes to not only acquiring technologies and talent, but also perceived innovation.
It's impossible to know whether Zuckerberg is right and virtual reality will really become the next major communications platform, but a $2 billion bet, analysts say, doesn't seem crazy for a company of Facebook's size. Josh Lipton, Nightly Business Report, Menlo Park, California.
Let's turn now to Victor Anthony for his thoughts on Facebook. He's managing director and analyst at Topeka Capital Markets. So, Victor, is this a crazy move, or is this makes sense in terms of a big grand plan that Mark Zuckerberg has in mind?
Listen, I'm a strong believer in Facebook's core platform. I've been a bull since day one. I get the logic behind this acquisition that virtual reality could be the next generation platform. And with Facebook's ownership of virtual reality plus social, they were able to leverage the platform outside of gaming into new communications and social and enterprise use cases. So I get that. However, I am somewhat cautious, and I'm taking a wait-and-see approach on this acquisition, and for two reasons. Number one, they talked about lots of monetization opportunities last night on the call. However, they weren't exactly clear what those are. So the financial payout for this particular acquisition is unknown, as well as the timing of this financial payout is unknown. And number two, there's an element of risk in Facebook's business model that did not exist 2 months ago, in that they're currently digesting 2 acquisitions. If there's any sort of hiccups through the integration process, I fear that could distract the management team from the core platform, which is performing extraordinarily well today based on my checks.
Mm-hmm. Victor, not too many software companies have done all that well. Notably, Apple, a different one, but it began as a hardware company. Not too many software companies have done well when they've gone into hardware. What's the history tell you?
Well, listen, I think, what Facebook is trying to do is expand, outside of their core platform and attract a new base of users and create and address any sort of new platforms that exist in the future. So I get what they're doing. Like they said last night, they're not really looking to be a hardware company. They're just really looking to use the software and expand that software.
All right. Victor, if you had to describe Facebook 2 to 3 years from now, give us a short description of what the company's going to be known for.
Well, I think it's still going to be known as a social platform where everyone essentially around the globe really just coalesces and gets together and communicates. So it becomes, I think, what is a communications platform. It becomes a search platform as well. And I think it becomes a platform, a knowledge-based platform where you could just essentially just find whatever you're looking for.
You have a buy rating on this stock, Victor?
Yeah, I do have a buy rating. I do have a $75 price target on the stock.
Do you feel as good about that buy rating today as you did Monday?
Well, like I said, my buy rating is predicated on the core platform, which I think is performing extraordinarily well. I do think there's some sort of risk now in the business model that didn't exist 2 months ago because there's 2 acquisitions. So, you know, I'm taking a wait-and-see approach. I am somewhat cautious, but I'm still at a buy. I think the core platform, which what my estimates are based on, is still performing extraordinarily well. I would take advantage of the weakness.
All right. Victor, thanks for coming by and talking with us. Victor Anthony, Managing Director with Topeka Capital Markets.
Well, this was not the initial public stock offering debut that King Digital had hoped for. The game maker, best known for the mobile game Candy Crush, saw its shares get crushed on their first day of trading, sliding more than 15%. But King Digital CEO Ricardo Zacconi doesn't sound crushed about the inauspicious debut for the stock or about prospects for new video games and players.
What we want to achieve is not to find another Candy Crush. That's not what we are here for. What we are here for is to build a portfolio of games. We want to build a network of players, of loyal players, who play a portfolio of games. And you can see that, you know, we have now 3 games in the top 10 grossing on all key platforms.
With today's IPO, King Digital is now valued at about $6 billion. Candy Crush counts 97 million players.
Well, the slide in Facebook and other tech stocks dragged down the major averages today. Also weighing on the markets, renewed concerns about Russia on reports that it has 30,000 military troops stationed along its eastern border with Ukraine. Speaking in Brussels, President Obama urged European allies and NATO members to condemn Russia's annexation of Crimea.
And that's why Russia's violation of international law, its assault on Ukraine's sovereignty and territorial integrity, must be met with condemnation.
On Wall Street, stocks sold off sharply despite one upbeat economic report. Orders for long-lasting durable goods in February were more than twice as high as forecasted. The Dow fell nearly 99 points. The tech-heavy Nasdaq lost 60. The S&P was down 13 points.
Well, even though the markets are still near historic highs and home prices are higher, the outlook on the economy for many Americans is still not close to where it was before the financial crisis. Steve Leisman takes a look at a new survey that shows how many of us are feeling about the economy right now.
America's views on the economy, little changed in this quarter despite stronger growth in jobs numbers to end the year. The CNBC survey finds that 81% of the public still view the economy as just fair or poor, and only 17% think the economy is good or excellent. That is barely changed from the December numbers, although it is an improvement from the depths of the recession. Still, economic views remain depressed compared with how Americans felt before the financial crisis. Now, economic expectations were a touch better, with a third of the public seeing the economy improving in the next year, but an equal share says it will likely get worse. Behind this muted economic outlook, Americans see their wages and housing prices growing only around 2% next year. Both are down for the December survey. Attitudes on stock investing were also largely unchanged. 39% say it's a good time to invest in the market. Now, the public's views on the stock market have really yet to recover their pre-crisis levels, even though most major stock indices have recovered and are actually higher than those levels. And in a sign of changing times, 56% of Americans said it would be acceptable to have a business selling marijuana in their city or their town, but support drops to 48%, under half, when asked if it's acceptable to have such a business in their neighborhood. Only a third of Americans would invest in a business that grew or sold pot, and a little more than a quarter would work at such an establishment. For Nightly Business Report, I'm Steve Leisman.
And to read more about Americans' views on the economy and the stock market, head to our website, nbr.com.
Still ahead on Nightly Business Report, Blackrock CEO sounds the alarm, warning corporate America to think twice when it comes to stock buybacks and dividends. Is that a risk to long-term growth? That's coming up.
The battle is heating up between an activist shareholder and Darden Restaurants. Barrington Capital Group isn't just calling for a restructuring of the company, but now also for a new CEO. Darden says it's doing what's in the best interest of shareholders.
What is in the best interest of shareholders? Well, that question was a hot topic of debate today, thanks to a strong warning from Larry Fink, the CEO of Blackrock. That's the giant investment firm. He sent a letter to all the CEOs of the S&P 500 warning that the recent trend of issuing dividends and stock buybacks under pressure from activist investors jeopardizes a company's long-term growth. Here's what he wrote. Many commentators lament the short-term demands of the capital markets. We share those concerns and believe it is part of our collective role as actors in the global capital markets to challenge that trend. Fink did not mention any specific activist hedge funds, but pointed out that big companies have become vulnerable to short-term thinking.
So does focusing on short-term gains jeopardize a company's long-term growth? We have two different views on the topic. Don Steinbrugge is a managing director at Agecroft Partners, a hedge fund consulting firm. And Bill George is the former CEO of Medtronic and professor of management practice at Harvard Business School. He's been on many, including many of the most prestigious boards in the country. Bill, with that in mind, let me begin with you. Mr. Icahn, among other activists, is very critical of corporate boards, says they misuse shareholder capital, and that the managements and the boards aren't acting in the best interests of shareholders. I assume you would say that has not been your experience at all.
Not at all. And in fact, Carl Icahn is going after eBay right now, and eBay's had a 465% return to shareholders in the last 5 years, Tyler. And you know, he's attacking some of America's best companies. Yes, corporations need to make sound capital decisions. They need to decide how much for growth, how much for acquisitions, how much they're going to return to shareholders on dividends. These are capital structure questions. I think they're sound. We got too far that way back in 2008, and that led to the financial crisis. The banks didn't have enough capital to keep them going. So I think Carl Icahns of the world, you see Nelson Peltz trying to do the same thing with a great company like PepsiCo, break them up, try to get a short-term hit. Carl's just looking for a short-term hit. He's not concerned about the long-term growth of eBay. And I'll tell you, with the moves that Google and Facebook are making, unless eBay continues under John Donahoe to continue to invest and build their platform with PayPal and other aspects, they're not going to be as competitive in the global market. And that's what we in America need. Great global companies going after the global market, like PepsiCo is doing, like Coca-Cola is doing. I think that's really critical, that we're investing in our long-term future growth. And yes, we want to give fair dividends back to our shareholders. If we have excess cash, I'm on the board of Exxon. Exxon generates a lot of cash, and they have good shareholder return policies. But unless you have a lot of excess cash, I don't think you should be giving it all back to shareholders. I think you should be investing for the growth of the company.
All right. So let's get Don into this conversation. I know you're on the other side of this debate. Make a case of why people like activist investors like Carl Icahn or Nelson Peltz or Dan Loeb are working on behalf of shareholders and for the best interest of the company.
Well, first of all, I do disagree. I think in general, corporate management are more focused on doing what's good for the corporation as a whole than shareholders as a whole. And I think activists are checks and balances on corporate management. You know, if they return money to stockholders, who's benefiting? It's benefiting it's benefiting the economy because that money is then redeployed into private equity, venture capital, new businesses, and so forth. So if a company isn't efficiently utilizing their assets, someone else should more efficiently invest those. And without activists, there's no checks and balances on corporate management to do that.
So, Don, do you think the real criticism here is that the activists act for short-term purposes, i.e. to return capital, in some cases, to their own pockets in the form of stock buybacks or dividends, and that it might not be in the best long-term interest of the shareholders, and that's what Larry Fink was driving at. Address that specifically, if you wouldn't.
Well, you know, Larry Fink is, a lot of his assets are in an S&P 500 index fund, and he's looking at it very long-term oriented from an individual company. What he's not thinking about is from an investor standpoint. An investor wants to allocate his money into securities that are going to generate the highest return possible, and our economy benefits from that. You want money coming out of less efficient companies and going into more efficient companies. So the overall economy benefits when money leaves inefficient companies and goes into more efficient companies. Larry's opinion was, I'm an S&P 500 investor. I have to hold this company long term. Long term, maybe this doesn't benefit the company.
Okay. Bill, in half a minute.
Can I just comment on that, Tyler? I think that if they are inefficient and they're not managing capital well, I think the point is very well taken. I think they should be challenged. But when you go after America's best companies that are looking for long-term growth and you ask them to play the short-term game, that doesn't help anyone. And I like Warren Buffett's statement. He says, I think that management and his board ought to run the companies where the shareholders are going to stay, not those that are going to leave.
We have to end it there, Bill George.
Takes into account the best long-term interests of the corporation.
And Bill George, we have to end it there. We lost the satellite. Don Steinbrugger, thank you very much at Agecroft Partners. And Bill is with Harvard Business School.
Shares of DirecTV and Dish surge on reports that the two companies could merge, and that's where we begin tonight's Market Focus. Dish Network Chairman Charlie Ergen reportedly contacted DirecTV CEO to discuss a merger of the two largest satellite TV operators in the country. Shares of both companies jumped about 6% today. DirecTV closing at $77.34, Dish ending the day at $62.09. Toyota will buy back nearly 2% of its shares, worth about $3.5 billion. This is the automaker's biggest buyback in more than a decade. The stock rose nearly 2% on the news to $110.53.
Baxter is reportedly exploring a sale of its vaccine unit in an effort to focus on its key businesses. Separately, there are also reports of a shortage of injectable nitroglycerin, which is the go-to treatment used on patients suffering from heart attacks. Baxter is the country's only manufacturer of that drug. The stock rose nearly 3% to $70.08. General Electric will build a $100 million jet engine plant in Indiana later this year to meet demand for its new engines. The turbines were to be used by Airbus and the Boeing passenger jets across the world. Shares fell slightly to $25.62. And coming up, the New York Times has an aggressive strategy to compete in this new digital world. But will it work? Another big auto recall to tell you about. Nissan is recalling nearly 1 million cars in the U.S. to fix faulty airbags that may not deploy in a crash. The recall involves 2013 and 2014 Altimas, Pathfinders, Sentras, and all-electric Leafs, and 3 of Nissan's high-end Infiniti models.
Another extension in the deadline to sign up for a new health care plan under the Affordable Care Act. The Obama administration now says that enrollees who have started to sign up for a new plan but have not yet completed their applications will now be able to finalize their coverages after the Monday, March 31st deadline. This could impact millions of Americans, and it's not clear yet how long the extension will last.
Leaders in the House and Senate have finally found something they can agree on. House Speaker John Boehner says he and top Senate Democrat Harry Reid reached a deal on legislation that would stop a looming 24% cut in Medicare payments to doctors that is scheduled to go into effect on Monday. The House will vote on the measure tomorrow, and that gave a boost to a number of hospital operators and other healthcare-related stocks. As you can see there, some of the biggest had some very sizable gains today.
The New York Times is going mobile. The newspaper just unveiled a pair of digital apps for smartphones and tablets as it tries to attract new readers willing to pay for news stories. But will today's consumers, so used to getting internet content for free, really pay for the Gray Lady's stories? Morgan Brennan reports.
The New York Times is launching a new app called NYT Now. For $8 a month, users will get selected content from across the paper's website that editors have deemed the most compelling. But the new app is coming with something else as well, what the company calls paid posts. Better known as native ads, it's a new kind of advertisement, and one that publishers like the Times hope will turn around declining ad revenues.
Native will be, in many cases, a primary form of advertising in digital and in mobile. And I think a lot of digital publishers are moving to that or embracing native because of that.
Native ads have been a source of controversy. They're the web's version of magazine advertorials, formatted like an article and giving an advertiser a platform for brand storytelling. And while they typically show up in editorial content streams carefully labeled as ads, it can sometimes be easy for readers to overlook those disclosures. Still, publishers like the New York Times are adopting them because they command a premium over other kinds of advertising. And while one critic isn't too concerned about an established news source like the Times, there are potential problems.
The journalism world is full of startups, full of new enterprises, full of people who are not as steeped in the history of the split between advertising and editorial as the Times folks are.
The Times first rolled out native ads on its website in January, joining a growing list of native ad adopters. Still, analysts say the bigger hope for the Times today is that its new apps will bring in more subscribers. That's because circulation has been driving revenues for the paper. It's also the reason that the company is launching a second offering, a new subscription called Times Premier. At a cost of $45 a month, the Times hopes to pull in additional revenue from its most affluent subscribers. For Nightly Business Report, I'm Morgan Brennan.
Finally tonight, as the boys of summer gear up for the start of a new season, for the first time in 15 years, the Yankees no longer have the sport's highest payroll. The Bronx Bombers are now number 2 at $203 million, and the team paying out the most in salaries, the LA Dodgers, $235 million. Lowest payroll, the Astros, $45 million.
And let's play ball, right? That's Nightly Business Report for tonight. I'm Susie Garrett. Thanks so much for joining us.
I'm Tyler Matheson. Thanks from me as well. Have a great evening, everybody. We'll hope to see you back here tomorrow night.
Nightly Business Report has been brought to you in part by
TheStreet.com. Founded by Jim Cramer, TheStreet.com is an independent source for stock market analysis. Cramer's Action Alerts Plus is home to his multi-million-dollar portfolio. You can learn more at TheStreet.com/NBR.
I'm Susie Garrett with the Nightly Business Report news brief. The Federal Reserve coming down hard on Citigroup and a handful of other banks, barring them from increasing their dividends or buying back their own stock until they have enough cash on hand to withstand another financial shock. Shares of King Digital, the maker of the popular video game Candy Crush, falling more than 15% in their debut. Facebook shares had their worst day in 4 months, falling 7% as investors question its $2 billion acquisition of a virtual reality goggles maker. On Wall Street today, the Dow fell nearly 99 points. The tech-heavy NASDAQ was off by 60, and the S&P 500 fell 13 points. And rival satellite TV providers Dish Network and DirecTV are reportedly discussing a merger. Be sure to tune into Nightly Business Report right here on your public television station.